Ever heard the phrase first position? When talking about real estate loans, but weren't really sure what it means? Or why every bank, private lender, and hard money guy wants to be in first position every single time? Alright, well today I'm going to be talking and breaking down exactly what first position means, why it's so critical for lenders, and how it can make or break your next deal as an investor. I'm Jarrett Lau, founder of Profitable Properties Boston. I own over $20 million in real estate in the greater Boston area and have years of experience both in real estate finance as a mortgage broker, and I've helped clients secure millions of dollars in funding by helping make sure everybody understands the real rules of the game. By the end of this video, you'll know what first position means in plain English, why lenders absolutely demand it, and how this simple concept can save or cost you thousands of dollars on your next investment. So let's make it simple. First position means the first in line to get paid back if something goes wrong, like if your property is sold at foreclosure. Think of it like a stack of IOUs against a house. Whoever's in first position gets paid first from the sale. Second position gets what's left over, if there's anything left. Third, fourth, and so on, keep whatever crumbs remain. Usually the first position is held by the bank or a lender who gave you your main mortgage. Lenders want to be in first position because it dramatically lowers their risk if you default and the property has to be sold. The first position lender typically will get paid back before anyone else, even before you as the owner will see a single penny. So real example, let's say your property sells at foreclosure for $400,000. Your first position loan is $300,000, and there's also a second loan, maybe a line of credit for $80,000. The first position lender will get their $300,000 first, guaranteed, and that second lender only gets paid if there's money left. So in this case, they get about $80,000. But if the property is only sold for $350,000, that second lender position would only get $50,000, and they might lose the rest. That's why banks will fight hard to be in the first position. It's going to be the safest bet for their money. Now, why does this matter for you as an investor? When you get a mortgage, your lender will almost always require it to be in the first position on the property title. It's why you usually can't take out other loans like a second mortgage or a HELOC without your first lender's approval. And private and hard money lenders, same story. They're going to want first position for protection. If they're in second position, they'll charge a much higher interest rate to cover the extra risk. What happens if you try to stack multiple loans? The higher risk for the lender, the further they are from the first in line. The harder it is to get approved, and the more expensive your loan is going to become. So let's bust a few myths. First position is just a technicality. False. It's the most important thing in loan risk. I can stack as many loans as I want, not without the lender approval. And each one gets riskier and more expensive. If my property values go up, I don't need to worry about the position. The sales price is never guaranteed. Position is everything when it comes to something like a foreclosure. Now, here's what to watch out for. Always know who's in first position on your property before taking out a second. Double check your first lender's requirements and approval process for even having a second loan on it. If you're lending money as a private lender, always secure the first position if at all possible. If you've ever been confused about the loan position or had a deal blocked because of it, go ahead, drop your question or your stories in the comments below. I'm going to do my best to answer every single one personally.